can you invest in Treasury index notes? Well, my firm, we build them. Here's the problem. Are they available on the street? The shorter answer is no, they're not available on the street. However, there are similar products on the street. So anyway, this is interesting because what you could do on the street is you can buy these on the street. They're called structures. They're not index treasuries because a lot of them don't back their money with the Treasury, which means you're introducing default risk. If you build these, let's say an insurance company, an annuity, let's say you build it with junk bonds or corporate bonds, you're introducing risk. With a Treasury, there's no risk. Does that make sense, Susan? Okay. We use only exchange-traded options. Most of the street uses OTC options. Now, why is this important? Well, this is important because of what Warren Buffett said. Derivatives are weapons of financial mass destruction. Derivatives, over-the-counter derivatives, caused the 2008 meltdown. So I'm going to take a little spin back. When I teach this class on money, I'm going to spin back to 1998 and Robert Rubin. Robert Rubin was a Treasury Secretary under Bill Clinton. Bill Clinton. We have a joke going there. But anyway, Robert Rubin was the CEO of Citibank, and he's the one responsible for getting rid of Glass-Steagall, where commercial banks could be bought by investment banks. That was one of the problems that caused 08. But the big problem that caused 08 was, in 1998, the largest hedge fund in the world was Long-Term Capital Management. Rick knows about this. Long-Term Capital Management almost took the banking system down. They lost billions of dollars. The Fed got together and said, we have to chip in money to save our banking system. And so there was a lady that said, you know, these over-the-counter derivatives could destroy the banking system. So we need to put every derivative on an exchange. And that was Brooksley Born. She was the head of the Commodities Futures Trading Commission. She basically said that every derivative should be exchange traded. Now, exchange traded means that there's no counterparty risk, that if Lehman Brothers go out as a business and AIG is their counterparty, AIG would have had to put up billions of dollars to secure those collateral as debt obligations, and the housing market wouldn't have gotten destroyed. Well, guess what happened? When she proposed this law, guess who didn't like it? The three wise men, because they're all bankers. He's the biggest private banker. He's the head of the Federal Reserve, which is a private cartel. You got Robert Rubin, and you got Larry Summers, right? Mr. the Genius, right? The guy that the president of Harvard. Anyway, they basically ganged up on Brooksley, convinced Bill Clinton not to regulate derivatives, and exactly 10 years later, we had the 08 crisis. Wouldn't have happened if we had exchange-traded derivatives. So the bottom line is we only use exchange-traded derivatives, and they're 100% protected, backed. Never has an exchange ever gone out of business. The structures are fixed, the fees are high. The reason why is, when you buy from the street, A, you're going through a middleman. B, the fees are high. They're not using treasuries. And the big one here is most of them are building it with derivatives that are weapons of financial mass destruction. Ours are adjustable, low fees, built in-house, backed by the U.S. Treasury, exchange traded. The reason why Alan Greenspan and Robert Rubin and Larry Summers did not want to put OTC derivatives on an exchange is because banks make huge amounts of money on the spreads between these over-the-counter derivatives. So the markups are huge, the spreads are huge, and the profit margins are huge. Exchange-traded derivatives are very tight, the profits are very thin, and the mark-to-market is very exact. So you could look on your computer and you could pretty much get that price. Over the counter, you don't know.